Hi, welcome. I'm glad you made it to this fractional investing session. And what I want to do is explain to you exactly how to get up to 10.7% and even higher returns plus capital growth starting from just a $60,000 investment. And believe me, it's much better than keeping your money in the bank. I've just invested in one of these myself, and it's a really good way to actually make your money work for you. Now, the two biggest problems with property investing in Australia today is that the property prices have been rising and the returns on these properties have been dropping, which makes it very hard for you to get a positive cash flow investment. It's getting harder and harder to get into the property market without getting into debt and negative cash flow. You can see that article on the right talking about how much the prices have risen over the last year or two. Now, the best return and capital growth property investments today, if you have the money, is rooming or co-living properties, and I'll explain to you a little bit about what they are later on. The NDIS SDA housing, and of course overseas projects such as Bali, but they're not without their problems. If you want to know more information about those, I can give you more information. But for this exercise, as far as the fractionals go, we're going to be talking about the rooming house and the NDIS SDA housing. Now, many investors that we talk to tell us, I would love to buy $1 million plus rooming or an NDIS property to get these high returns and that capital growth, but I just can't afford it. I don't have enough money, and that is probably why you are here watching this video with me right now. So the solution, of course, is to invest according to your financial means. Now, you can invest in obviously 100% of a property where you own the whole thing, you get the loan from the bank, you're on the hook, if you like, for the whole property. Or with these properties, you can invest from as little as 5% up to 35% as tenants in common share ownership. I'll explain to you a little bit about what that means later on, but it is a much better way for you to actually get into the property market without having to wait until you've saved up more money. Now, the main benefits of fractional share ownership is that you can invest in these fully managed NDIS and rooming and co-living property investments, which do offer the higher rental returns and excellent capital growth, but you can do that without going into debt, the stress of getting loans, loan applications, and having to wait, and of course save more money to start investing. And while you're saving, the prices are rising, and it's always just beyond your reach. I do not have any money in the bank at all. All my money is in property, including one of these shares, because you actually get the same returns, the same capital growth, and the same ownership rights and flexibility as if you own the whole property. And that's the beauty of this type of investment. You're investing today without the stress of the debt, and as I said, without having to wait for to buy the whole property. Just before I get into it, just give you a bit of background as to who am I and why you should listen to me. I have actually started investing in 1984. And that's when I bought my first property. And since then, I've purchased 24 more properties for myself. Now, I still hold a current Queensland real estate and auctioneer's license. And I do a lot of research for my own investing, which I then share with my clients. And now what I do is I actually help people get into the properties and find the properties for them. Now, this is one of my properties that I own on the Gold Coast. I'm at $1.9 million profit on this one. That's what it looked like before the lounge room. I actually did a renovation on that one. You can see one of the bedrooms, self-contained bedrooms downstairs. This was the master bedroom. That was after I renovated it. Here's another property. Now, do you think it's possible to actually make $210,000 in 6 months from a one-bedroom apartment? I bought this one in March 21, sold it in October 21. And you can see that I bought it for $530, sold it for $740. That's what it looked like before. Then I transformed it into this beautiful one bedroom. That was one of the second bedrooms. There's like a study and a sofa bed with mirrors on the wall. And here was the master bedroom before. This was what I turned it into. Not only do I have properties such as the fractionals, but we also show people how to renovate. I've done a seminar on that. Or you can read one of my books, How to Sell or Rent Your Home Faster and for More Money. If you want a copy of that, just go to our website or contact whoever sent you to this video. And I've also written books such as Creating Wealth with High Return Real Estate. We can send you a copy of that. Beginner's Guide to NDIS, Building Wealth with NDIS Property. Also Boom Suburbs, How to Find the Growth Areas that are going to make you the most money and invest in the right areas and states. And also the Beginner's Guide to investing in Bali. This is one of my last investments. It was actually a fractional property in Western Australia. I paid $62,000 for that one, and the expected return is 13.3%. Now, it was a STA robust dual key home, and the net's going to be about 10.6% with $6,600 per annum coming in from the $6,000 investment. On top of that, you've got capital growth. Now, the returns on those properties have now dropped, right, because prices have risen. So most of our fractionals today are around the 10% mark. Now, before I get into the actual nitty-gritties of fractional investing, let me just share with you a bit of a reality check and the legal stuff. Right? The information provided here is for general information. It's not legal or financial advice. It's just an education to get you up to scratch in what you can do. Please seek your own independent legal and accounting advice relevant to your personal situation before investing in any property. And by the way, all investments carry both potential risk and reward. If you get rich as a consequence of attending this event, it's not my fault, it's because you took action, right? And we recommend Ishaks. They are actually in Sydney-based solicitor company. They can do conveyancing all over Australia, every state. Most solicitors cannot act for you if they're out of the state that you're in or they're in. So these guys, they deal all over Australia, so we highly recommend them. All right, let's talk about fractional ownership and how it actually works. So TIC basically is a property investment fund, stands for tenants in common, as I said before, and they will own 65% of the property, and then there is 7 shares of 5% available to smaller investors such as you and me. As I said, I bought one myself last year. But if you're buying a smaller portion of a property as tenants in common, but you're still getting the same ownership benefits as if you own the whole property, right? So there's no disadvantage to you. The property developer and 60% financier is a Sydney-based investment fund. They're called Supervest, and they have approximately $200 million available for funding and developing these quality NDIS and rooming house properties available as the tenants in common investments. Now, the question is, how secure is this investment? Well, it's just as safe as buying any other property in Australia. There's only 35% or 7 times 5% shares of the property is sold to the smaller fractional investors. 65% is held by the developer who manages the build, does all the organizing of any finance, and will also manage it and make sure that they get the tenants after it's finished. They want it to be a success as much as you do. So they've got a very good partnership with another company, which I'll share with you in just a minute. And they're all working towards making this a success for you and for me, obviously, because they've got a stake in it as well. Now, the fractional ownership actually allows multiple individuals or companies or trusts, you can buy it in any combination, to actually own an interest in a property. Now, you can now enter this high yield real estate market, which normally you wouldn't be able to because of the costs, but you need a lot less capital and greater flexibility, and you're still getting all the benefit of the capital growth and the rent that these properties actually bring you. Now, it's been done in the past, fractional ownership. A lot of people were doing that with boats and planes, right? So basically, that's where, anywhere from 2 to 10 people own a share in a plane or a boat, and they use it a part of the year. But overseas, there's been a lot of this kind of fractional property sales in America. For example, there's one in Newport Beach. Here's another one in Bali, a fractional. I've actually had a look at that property. There was a really good investment. I think they've all sold out now. There's also another one in Sweden there for sale, and another villa in Bali also as a fractional. So it's been around for a long time, but it's fairly new to Australia. And it's only because now in Australia, property is getting unaffordable why this has been brought into the marketplace. Now, you're still getting those 8 to 12% returns starting from around that $60,000 mark. And you can actually own now a share of these high return property, and investments that you couldn't afford for your budget. And that's an example, the one on the right there, of the one that I actually bought in Perth, Western Australia. And as I said, unfortunately, that was last year. The returns have dropped a little bit as prices in Perth have gone up substantially, but you're still getting around the 10%, 10% return. So the ownership structure is called tenants in common. Now, the tenants in common contract is where more than one person or a company or a super fund or a family trust, right, owns a percentage share of a property independent of all the other owners in that, in that property. The individual ownership shares don't have to be equal. And it's different from joint tenants where, for example, if you buy a property with your partner, your wife, your brother, your sister, right? If one person passes away, the other one automatically gets ownership of their shares. One person cannot sell their share independent of the other. They're all going to be sold together. Tenants in common, you're completely independent, right? It can be sold independently of the other shares. It can be passed on in a will or disposed of in any way you like, based on your wishes. Now, let's summarize the benefits of the fractional investment. Number one, it is affordable, right? You can start with as little as $60,000, as I mentioned before. Number two, it's secure. So you actually go on title at the titles office, just like you would if you purchased 100% of a property, right? You have legal ownership in a percentage share of one or more NDIS or rooming or co-living properties, right? So it'll be registered. You'll get rates notices proportionate to the share that you own. You get the same high rate of return as if you invested in 100% of the property. It's one of the major advantages of this type of investment, because otherwise, you're investing in cheaper properties because you want to invest in something, but you're getting negative cash flow, and the capital growth ultimately is pretty much the same for all properties across Australia. So you will get that full benefit of capital growth of the property based on your percentage. So if you own 5% share or 10% share, you'll get that share of the capital growth, such as that example on the page there on the right, but I'll explain that in just a moment in a bit more detail. And of course, tenants in common is very flexible, right? Your share is completely independent of the other investors. That's one of the great advantages, because you can sell it at any time, you can gift it to your children, or you can simply leave it in your will for future generations. It's really up to you. Now, the other thing you can do is diversify your investments. Right, so you can invest in several different areas and properties under this fractional arrangement, where you own a fraction of the property in WA, in Queensland, in Victoria. So basically diversifying your portfolio. The biggest drawback, I guess, is that you cannot live in that property you have a share in, and you can't borrow against the investment because there's the other shareholders, and you can't have like 7 mortgages against the same building. But you're still getting all the benefits of the growth, so you're not going to move into those properties anyway. So the other question we get a lot is, can you sell your fractional investment? Look, the answer is absolutely yes. You can sell it anytime. You can also will it to anybody. And Supervest, the 65% share owner, actually wants the first right to purchase your share. And what you do is you get 2 valuations. They get one, you get one. And then the average of those valuations will be basically what the property can be sold for at the market value at the time. We can also offer it to new investors or current owners who want to increase the shares in their property, in which case normal REI selling fees are going to apply. But it's as I said, the first right of refusal, it goes to the biggest investor, which is Supervest. Now, the other question that people often wonder about is, will the property and your tenants in common shares also have capital growth? And again, the answer is absolutely yes. Once these properties are built and tenanted, the property is worth more, sometimes a lot more, because your share is now valued at a fraction of the finished property with real returns and commercial yields under which these properties are sold. And there on the right there, you can see the graph of the intersection of these two things, the capital growth and also the rental returns on these properties. And I'm going to go into a bit more detail just here. Basically, a $54,000 initial investment, this was for one of the properties we had for sale, could be worth up to $110,000 in 10 years. Plus, you're going to get the rental income for that period as well. And we're basing this on historical Australian property values, as you can see in that graph in the bottom right. That's properties have been going up for the last really 140 years in Australia, especially after World War II. It's been a very steady increase with just a few periods of downturns or leveling out. But in year one, let's say you buy it around 54,000. Some of our shares every now and then come up. They're a little bit cheaper than the $60,000 mark. And then in 10 years, that should be worth around $110,000 from that example. Now, if you look at the 10-year rental return you buy, if you buy this share in your super fund, which is obviously tax beneficial as well, your rental return after 10 years will be around $76,814 for that $55 to $60,000 share. The 10 years capital growth will be $55,000. Right now, when you add those two together, after 10 years, your initial share that you paid $60,000 for, you would have made $131,000, which I'm sure you'll agree is much better than keeping the money in the bank, because if you kept that same amount in the bank at 5%, you'll have just $33,598. Or if you add those two up, it's about $88,000 as opposed to around $180,000. So you're around $100,000 better off by investing in a property like this one than keeping your money in the bank. And look, this is all based on historical Australian property value increases of 7.2% average per year, plus CPR rent increases on the rental income. The actual results obviously could be a bit more, could be a bit less, but that will give you a good idea as of the value of this type of investment. You know, I don't have any money in the bank. I've got like $200 in my cash accounts because I have a redraw facility on my loan to one of my properties, but all my money is in property because I want to get the capital growth as well as the income, especially if it's positive cash flow like this. It's not taking money out of your pocket. It's giving you money every week, plus you're getting the capital growth. You don't want your money sitting in the bank because your money is always getting less with inflation. Everything's getting more expensive. You can purchase less with that money. Have you heard that saying, cash flow is... Yeah, that's right, king. Right? Cash flow is everything. These properties are high cash flow properties. That's the sort of properties you should be investing in. But the beauty is they're also making a very, very good profit. Here's an example of a rooming house that was actually built in Brisbane by a company called Altitude Homes. Now, they sold it back in 2023 for $1,080,000. Now, with a 9.88% yield to the investors. So around the same yield as what you're getting into these fractionals. But in just less than 11 months, it was resold for $270,000 more, 1.35 million. So you can see the capital growth jump. That's why I'm showing you this example. And the new investor who bought it fully tenanted, you know, ready to go, they're only getting an 8%, 7.9% gross yield. So you're much better off getting in early and then getting that higher yield and the benefits of the capital growth. It's not a fluke. Here's another one. Most people keep these properties long term, but this one was another one that was resold, bought in 2023, projected rent 9.74% gross yield, resold in 2024 with a 23% increase in around 11 months again, built and tenanted, $245,000 profit for the investor and a 7.88% gross yield again. These ones weren't available as a fractional, right? They were developed by Altitude Homes in Brisbane, but it's a good example of how much these properties are worth once they're actually completed. Now, the two people and companies that are going to be essential in management, especially of the NDIS SDA properties, which are a little bit more tricky to get tenants for, is Supervest, Raymond Hampstead there, and also Anthony Sewell, who is the managing director of SDA Management Australia. They're the ones that actually design these properties, these NDIS properties, and they're also going to be getting tenants for them. So let's just listen to what they've got to say.
We believe we've got a great product that can achieve these numbers, achieve these results in real terms. Yeah. I think there's a lot of other companies out there with NDIS products that definitely can quote all the numbers, but whether or not they can achieve it, that's the bit that's a tricky bit. Yeah. But because we own the property investment store that designs and work with the builders to build these homes, then we own SDA Management Australia that runs the management, looks after the management of these properties. We currently have a 95% occupancy rate, and we know what we're doing on the management side because we work with relationships and all these providers that we work with to be able to get the tenants. We know these numbers are real from a management point of view to what we can achieve. That's why we believe the two products have great synergy between us, because you have the structure, but we've got the product that we can join together and create a really well-structured product that's actually going to achieve the results we want to achieve for people. And we're not trying to boss the numbers up. We're trying to be realistic about what we're saying. Once again, if we don't get a tenant in that property, then we don't get paid. So it's up to us to get a tenant and make sure we get a tenant. We want to keep the structure as simple as we can and have the ability for people to invest in this and to further their financial situation. Even from a small amount of money, they can develop into quite a large sum of money in no time.
Very much.
And I mean, growth and rental income.
Exactly, and that's where safe property opens up that whole market. And
That's right. So these two guys have basically combined, especially Supervest, created this rooming and NDIS fractional opportunity. And Anthony is one of the people that manages the NDIS properties. There's other people that manage the rooming house properties, but everything is fully managed on your behalf in these properties. Now, the properties at the moment that we have, they're located in WA, Victoria, and Queensland. We've got some ones that we've had in New South Wales that have now sold out, but they are obviously a lot more expensive in New South Wales. So the best ones currently are in Victoria, Queensland, and WA under this fractional arrangement. There's three ways that you can invest in these properties. One is you can get an equity release from your current home or a redraw facility on your home. You can use the money you have in your self-managed super fund. That's what I did, right? I had like an extra $70,000 sitting in my super fund, getting a measly 4 or 5% interest. So I put it into one of these fractionals at that 13.8% return or 13.3%. As I said, now the return's a bit less, but don't wait until the returns drop again, because as prices rise, the returns of property drops. Imagine if you bought a property 20 years ago, you'd be getting 40, 50% return on that property today because the property's gone up in value, but you bought it at the lower price and the rent keeps rising, so your returns get higher and higher. So you want to get in as quickly as you can. And of course, if you got cash, you don't need any help, but don't keep your cash in the bank. I don't know how many times I've said this to people, and yet people still insist on putting their money in the bank and looking at their bank account with all that pretty money sitting in there. But guess what? Inflation is eating that money away, and the longer you wait, the less you'll be able to do with it. Like one of our potential clients who has like $400,000 or $500,000 in the bank account, and she's been sitting on that for about 8 years, and she's still got $400,000, but the property she could have bought for $400,000 now worth $800,000. She could have potentially doubled her money in the 8 years she's had that money sitting in her bank account, and now she's getting, she can't even afford a property because, you can't buy a property and she can't borrow. So get in as soon as you can. That'll be the best thing you can do with any property investment. Now, here's an old customer and a friend of mine, Mark Fregnan from Perth, and he's actually been looking at extra properties, and let's see what he's got to say.
I've been following you for quite a few years, and like most people, I want to be able to retire comfortably and get the best returns on my investments. I'm actually looking to purchase another property, but as you know, most properties are really expensive right now. And so I came across NDIS and the fractional investing that offered basically high returns and capital growth. And so sort of served all those main things for me. One was affordable, good returns and good capital growth. And I can see where those properties are located as well, like you showed me on the map, where those different properties were all across Australia. So that allowed me to get involved with the process as well, which I liked. And looking to get my investment back in 6 or 7 years.
There you go. Mark's recognized the benefits of this type of investment. He's already invested in other properties before, but this just allows him to top up, his investments. So let me explain to you the types of properties that you're going to be actually getting a share in. First of all, NDIS, in case you haven't heard from this, it basically stands for the National Disability Insurance Scheme. It was started in 2013, and basically it provides government-paid funding for support services and accommodation to approved participants under the NDIS scheme. So not all participants have the accommodation portion of it, but the SDA is basically specialist disability accommodation, and that is the housing that is specially designed for people with extreme functional impairment or very high physical assistance needs. And this can include sensory, speech disabilities, people in wheelchairs, intellectual, physical and mental disabilities, etc. And the people that actually get the SDA rent assistance from the government, these payments are up to $110,000 per year and even more in some areas, available for each individual and directly by the government to those NDIS properties. Now, the actual amount actually depends on the level of disability, the type of home they will need, and where it is located. And I think last time I looked, there was like 150 different combinations of payments, but they are all substantial. Some of the NDIS properties are getting 12-13% returns. Even one tenant can get you around 10% return. So that's basically NDIS. Now, rooming houses or co-living, this is the other type of investments where these fractionals are available. So let's look at what is a rooming or co-living house and who are the ideal tenants. Now, these are purpose-built properties that often look like any residential home on the outside, right? But the reason they're rooming or co-living is because inside is fully furnished private studios or micro apartments, each approximately equal in size. Plus there's a common kitchen and laundry all under the one roof. So you're basically getting 5 rental incomes from the one property. And these are fantastic from an investment point of view because they get you 2 to 3 times the rental income from a very similar looking property in the same street. You can be looking at 2 properties. One's getting $600 a week, the other one's getting $1,800 a week because one's co-living, the other one is just a normal 4-bedroom, 2-bathroom family home. So behind me, I've got 2 properties in the same suburb, right? Now, this one is a normal house and land, which will rent for $500 a week. The one next door to it looks exactly the same from the outside. However, inside is 5 separate bedrooms, 5 living rooms, 5 bathrooms, 5 kitchenettes, 5 courtyards, and that one is going to rent for $1,750 a week. Now, from the outside, you can't see any difference, but the big difference is what's on the inside, and of course, the returns you're going to get. So one house, $500 a week. Second house, $1,750 a week, which is for this property right here. That is the difference between a rooming house and an ordinary investment. Now, the type of tenants that actually rent these ones, the residents of these rooming houses, they basically come from very diverse range of society profile, increasingly comprising from individuals such as healthcare, emergency services professionals, essential workers, divorcees, notably single women aged 50 plus. We've got some properties not under the fractional, but as a whole purchase where they're being tenanted by doctors and nurses from a hospital who actually takes a head lease on these properties and they put their staff in them. So there's a lot of opportunity to make really good income with these types of properties, either in the fractional or if you're buying the whole property as well. Now, the way it works is that each resident signs an individual lease agreement, just like any other rental property. The lease agreement is normally for a 6 to 12 month period, and it also includes all bills such as electricity, cleaning, and internet. And by the way, these units are fully furnished, right? So they come with all furniture they need. So you just basically bring your suitcase, so it's very convenient for the tenants. So let's summarize. Number 1, the most secure and reliable way to build wealth is to invest in income-producing properties. Look, what I guess stuffs you up in property investing is when you're buying properties that don't have enough income. They're negative cash flowed, right? Or negatively geared. You don't want that. You want properties that give you more money in your bank account every single week, because then the bank will actually lend you more money against buying another property later on. If you buy a negative geared property, oftentimes you can't buy any more properties. That's why these types of properties are the best properties to invest in. And we know that 90% of all Australian millionaires come from property as their property values rise over time. Now, the fractional investments offer you a chance to own a smaller percentage of one of these higher returning and capital growth properties today, rather than having to wait or buying a inferior property with a lower return, right, and negative cash flow. Now, you can invest 5 to 35% of an NDIS or rooming house fractional property with the same ownership rights and benefits and returns as if you bought 100%. The tenants in common flex gives you flexibility, that structure, right? You can hold your shares, you can sell your shares independent of the other investors. And look, I don't recommend that you plan to sell these shares the year after the property is built. I recommend holding them long term. That's what I'm doing. They're a great investment in your super fund for future income, especially when you want to retire. Now, you can invest in cash, self-managed super fund, or equity release from your home. Those are the ways that you can get into these properties. Now, where do you go from here? You like what you've seen so far. You want to take the next step. Look, the next steps from here is if you got questions, get your questions answered, right? Give us a call or whoever's sent you this video, and we can answer any questions about this investment that you might have. The next step is decide on the tenants in common investment amount that you feel comfortable making, or that is right for your current situation. Depends on how much money you might have in your super fund. And also we look at the location, where if you have any preferences on location. I personally just go for the returns, and look at what is the overall return and the benefit of that particular property. Number 3 is if you you decide to go ahead, then we get an expression of interest and authorize a $500 fully refundable holding deposit. Now the reason we do that is because we will contact the developers once we have the deposit and make sure that this share is still available, because a lot of these shares that we even send you information on, they go quite quickly once these properties are released. They're not coming up all the time, right? So if the particular property is not available, we'll come to you with other options or basically give you that $500 back. Now, if we find a share and can confirm a share and you're happy with that, then we will then get the developer's application sales advice form. And there's actually a $2,500 deposit, which is non-refundable, which is paid to the developer's trust fund, and Supervest trust fund to secure each share of the 100% property investment if you want to buy the whole property. And of course, you can do that as well. But it's $2,500 if you're buying 1 share to 7 shares within the same property. But if you're buying shares in more than 1 property, then it's $2,500 for each property that you want to share in. Now, Supervest will then generate the relevant purchase contracts in your name, and they'll also walk you through any documents and IDs you have to submit for whatever names you want the contracts in. So you can do this in your trust, in your self-managed super fund, in your own name, in a company name. It's up to you how you want to structure it. Obviously, get advice from your accountant on that one. And once you're happy, it all makes sense to you, then they issue the contract documents for you to sign electronically or in person, and you can then transfer the balance of the investment funds due to complete your purchase. The money for the entire share is due upon the signing of the contract, right? And once that's been done, the construction will commence, and usually the property is completed within 8 to 12 months from the date of your investment, once all the shares have been sold and the land's been obviously registered and transferred, and then you've got you've got the building that will take place. And look, your money is always secured in a trust fund or by the purchase of the land, right? The Supervest then borrows to build the property, right? And once it's all completed, then the rent starts coming in. Now, look, if you've been here till the end, thank you very much for staying with me. This is really one of the best investments if you can't afford to buy a whole property. Obviously, it's better if you can buy the whole property, but if you can't, then this is the second best option. Now, if you want a copy of my book, Creating Wealth with High Return Real Estate, I can send you a copy. I'll talk a little bit more about the fractional investments in there. You can contact whoever sent you this video. But whatever you do, do something, right? Don't keep your money in the bank, because that's not security. Put it into a property such as fractional, or even if you can afford it, buy a whole property, even better. We've got some of these rooming houses available from just $860,000, some of them, right? And these some of them get you over 10% returns, right? It is literally the best investment you can make today. So I hope you got everything you need from this. I'll look forward to speaking to you again. And whatever you do, give me a call or whoever's seeing this video and do something about it today, because real estate is not going to wait for you. It's always going up. And I remember people saying to my parents back in 1973, when we first arrived in Australia, that property was getting too expensive then, right? And they bought a terrace house in Bondi Junction for $50,000, which they resold for $150,000. Now it's worth $4 million. So don't be the person that's always thinking, oh, I'll wait till the property prices come down, or I'll wait to save up a bit more money, because you can never catch the market, especially today when the prices have jumped substantially. I'll look forward to speaking to you, and I'll talk to you later. Bye.
The new fractional rooming and co-living investments looks like a great opportunity for people starting out on their investment journey. My name's Shane and I live in Melbourne, and I've known Peter's son for a long time. We met quite a few years ago and hit it off straight away, discussing real estate and real estate opportunities. Since then, we've bought properties in similar areas and locations, and I've continued to get advice from Pete ever since. So so he's got a lot of knowledge and a lot of books on investment that you could gain a lot of experience from him.
Hi, my name's Nessie Rose and I'm a single wage earner for whom property investing was a bit of a scary experience for me. I've known Peter's son for over 15 years. Peter has lots of experience in property investing for himself, and this really helped me making my first property investment a lot easier. I was really hesitant. I had no experience in property investing myself, but now I've made over $350,000 profit in less than 4 years, and I am so looking forward to buying another one soon.
Hey there guys, John Gian here. First of all, I want to congratulate you for actually turning up today. You know what, success is really easy. Sometimes you just have to turn up. I first had the opportunity to bump into some of Peter's information about 12 years ago, and since that period of time, the revenue that I've generated, I can attribute to those early beginnings with Peter, which is in the multiple millions of dollars. If you really sit there and really get it and see how it applies to your life, let me say this to you. I know this is going to be a big statement, but you will never be broke again. If you really sit there and you embrace this information, that's a big call. You'll never be broke again. What Peter's techniques has enabled me to do is grow a really quick business, fast profits, and then I've rolled that into real estate. So I've had the opportunity to live an amazing lifestyle, travel first class, 5-star hotels, latest model Mercedes, live in multi-million-dollar homes, but still have enough money to put into real estate and build a massive real estate portfolio as well. So my system is business, put stuff into real estate, right? And that's how the billionaires do it, the multi-millionaires do it, and that's how I suggest you do it as well. So thanks for giving me the opportunity, Pete, to shoot this video.
Hi, my name's Steve Pollard. I live on Miami on the Gold Coast. I met Peter at the Oracle building in Broadbeach approximately 4 years ago, where I had an investment property and Peter had investments in the building himself, and I found Peter to give me some very solid advice. Further on, 2 years later, he actually sold the apartment to my daughter, and the investment property that he had put us onto has proven to be quite a substantial win for her, and we're very happy with the service. I think Peter is a very honest person. He wears his heart on his sleeve, and he has guided me very well towards other investments and investment ideas. I hope this is of assistance to you, and I wish you all the very best. Thank you.